Most people are waiting for cheaper loans. One man's appointment just made that wait much longer, and there's a specific thing he said, publicly, on the record, about his first 90 days in charge that almost no one is talking about. We'll get there. But first, you need to understand why this appointment hits differently than any Fed transition in recent memory. Here's what most people think is happening. The Fed raises rates, inflation comes down, the Fed cuts rates, mortgages get cheaper, car loans get cheaper, credit card debt gets easier to carry. That's the cycle everyone's been waiting on since 2022, and the expectation was that we were close. Maybe a cut or two this year, a few more next year, back to something resembling normal. That's the story most people are telling themselves. Here's what's actually happening. Kevin Warsh just changed that math. Not because he's some villain, because he has a genuinely different philosophy about what the Fed should be doing, and if he becomes the next Fed chair, that philosophy becomes policy. Policy becomes rates. Rates become your monthly payment. And the philosophy I'm referring to isn't new. He's held it for 15 years, through conditions that would have changed most people's minds. Why it didn't change tells you everything about what comes next. Let's make this tangible. Stop thinking about basis points. Think about dollars. Pull up your mortgage statement, or imagine you're about to sign one. The average 30-year fixed mortgage rate right now is sitting around 7%. On a $400,000 home loan, that's roughly $2,660 a month just in principal and interest. If rates had dropped to 5.5%, which markets were pricing in just a few months ago, that same loan would cost about $2,270 a month. That's $390 less every single month, nearly $5,000 a year. Over 30 years, you're talking about $140,000 in additional interest paid because the rate stayed higher. Read that number again, $140,000. Not to a better home, not to equity, to interest. That's not abstract, that's a car, that's a college fund. That's years of retirement contributions that never happened because the money was consumed by interest. And it's not just mortgages. There's a second group of households even more exposed than homeowners, and most financial coverage completely ignores them. We'll get to that. But first, if you're carrying $30,000 in variable rate debt, credit cards, a personal loan, a home equity line, a sustained high-rate environment costs you thousands more per year than it would have in a low-rate world. The people most exposed to this aren't wealthy investors. They're ordinary households who borrowed to live, not to speculate. So who is Kevin Warsh? Here's the thing about him that almost nobody leads with, and it's the only fact you actually need. Most people assume Fed officials are consensus seekers. Warsh is the opposite. In 2008, when the financial system was collapsing and the pressure on the Fed was to cut rates fast and keep cutting, Warsh was one of the few voices inside the room arguing for rate hikes, not later, during the crisis. When almost every instinct in central banking said flood the system with cheap money, he was worried about what that money would cost us later. He was largely outvoted, but he was consistent, and he never stopped believing he was right. That single fact tells you more about how he'll run the Fed than any biography. But there's a specific document, something he co-authored in 2023, that makes his intentions almost uncomfortably explicit. We'll get to exactly what it says in a moment. The biography, for context, Warsh served on the Federal Reserve Board of Governors from 2006 to 2011. He was present for the worst financial shock in a generation. He's credentialed, well-connected, and taken seriously by markets. But his defining characteristic isn't his resume. It's that he has held the same core conviction across 15 years of changing conditions. That easy money is a trap, that the Fed moves too slowly, and that short-term pain is preferable to long-term credibility loss. 15 years. Think about how much changed in 15 years. 2008, zero interest rates, COVID, stimulus, inflation, rate hikes. His position didn't move. In 2023, he co-authored a piece arguing the Fed needed to be far more aggressive about restoring its inflation credibility, not just reaching 2%, but anchoring there and making clear it would accept economic discomfort to hold that line. That's not a political statement, that's a governing philosophy. And the question you should be sitting with right now is, what does a man with that philosophy actually do in his first days in charge? Because the answer is not what most people are assuming, and it's more specific than you'd expect. Here's the part most people miss. Everyone focuses on what the Fed chair does to rates. That's the wrong place to look first. The Fed chair shapes expectations, and expectations are where the real money is made and lost before a single vote is cast. When traders and lenders believe rates are going higher or staying higher, they price that belief into everything: mortgage rates, corporate borrowing costs, the valuations on growth stocks, the yield curve. Jerome Powell could give a speech and move markets just by emphasizing one word over another. Warsh would carry even more conviction into that role because his views are more defined and more publicly stated. Here's a concept worth knowing. It's called the credibility premium. When a central bank is credible about fighting inflation, long-term rates come down because bond investors trust that inflation won't erode their returns. But when a new chair signals they're willing to be aggressive and stay tight, short-term rates stay high or go higher, and that's exactly what affects your mortgage, your car loan, your credit card rate. The bond market has already started adjusting. And the specific move in 10-year Treasury yields in recent weeks is not a coincidence. It's institutional money sending a signal most retail investors aren't reading yet. We'll get to what that signal means for your timeline in a moment. Now here's where this gets genuinely uncomfortable. Stop, because this next part is the thing that makes everything before it matter. Most people assume that when a new Fed chair takes over, there's continuity. The incoming chair inherits the existing trajectory, studies the data, and adjusts gradually. That's how it usually works. That's what markets historically price in during a leadership transition. Warsh has said publicly that he would treat the first 90 days as a credibility reset, not a continuation, a reset. His argument is that the Fed's inflation-fighting credibility has been structurally damaged, that it moved too slowly in 2021, communicated poorly, and created a trust deficit with bond markets that can only be repaired through decisive early action. In practice, that means the first 90 days of a Warsh Fed could look nothing like the final months of a Powell Fed. The playbook changes at day one. That raises a question nobody is asking loudly enough. If markets have already started repricing and the reset hasn't even begun, what happens when it does? We'll get there. Goldman Sachs and several bond analysts have already revised their rate cut forecasts. The bond futures adjustment is real and measurable. The people still planning around the old timeline are planning around a world that has already changed. Here's what most financial coverage is telling you: wait and see. Here's what the bond market is actually doing. It's not waiting. That leaves one open question, and this is the one that actually determines what you should do with your money. Now that you know this, what's the framework? Here's the framework, not predictions, not rate forecasts. 3 decisions that ordinary households should be stress testing right now against a higher for longer scenario. Decision 1, any purchase or refinance that only works at 5.5% rates. If the math breaks above that threshold, the math is telling you something. A Warsh Fed doesn't rescue that decision. You either restructure the terms, adjust the timeline, or accept that the numbers don't work yet. Don't build a financial plan on a rate cut that may not arrive on your schedule. Decision 2, variable rate debt. People think of debt paydown as boring, conservative, the slow path. In a higher for longer environment, it's the highest guaranteed return available to you. Credit cards, home equity lines, personal loans with floating rates, these are the most direct transmission from Fed policy to your monthly cash flow. Every month you carry $10,000 at 22% APR is over $180 in interest, gone. No investment is offering you a risk-free 22%. Treat aggressive paydown as your best trade. Decision 3, anything you're waiting to lock in. If you're buying, refinancing, or borrowing, and a fixed rate is available, the risk of rates moving higher is now meaningfully greater than it was 6 months ago. The optionality of waiting has a cost. Price it honestly. And here's the one I saved for last. The group I mentioned earlier that's more exposed than homeowners. That's variable rate borrowers who have been floating, assuming cuts were coming. If that's you, this third decision is actually your first decision. That's the framework, not prediction, not timing the market. Just running your actual decisions through a scenario that is now more likely than it was, and making sure you're not caught flat-footed if it arrives. We opened with one man's appointment making the wait for cheaper loans longer. Here's where that loop closes. Kevin Warsh may or may not be confirmed. Appointments shift, politics moves, things change. But the market is already pricing him in. and the rate environment you were expecting has already shifted whether or not his name ever appears on a Senate confirmation ballot. The pessimistic version of this story is, rates stay high, borrowing stays painful, the window you were waiting for doesn't open. The honest version is this: the people who come out of this period ahead won't be the ones who predicted rates correctly. They'll be the ones who stopped waiting for a rescue and built a plan that holds up in the world as it is. That's actually the most empowering place to land, because it means the next move belongs to you, not the Fed. If this is the kind of clear, no-hype money conversation you want more of, subscribe so you don't miss it. And drop a comment. Tell me what financial question you want me to break down next. I read them, and they genuinely shape what I cover.